welcome everyone. So as Owen said, my name is Ryan. I am one of the founders of Growth Studio. I'll tell you a bit more about what we do, but really, I think the key thing is we work very, very closely with founders exactly in the same situation as yourselves. So founders are early stage founders that have a great idea, which they've developed to some degree, but now in order to see it through to the next stage, they need money. Before I go any further, here's something that we know everyone always wants. We get a lot of questions here at Growth Studio from around the world, from startups around the world, which is why many of the places I was reading about, we've been to, working with startups just like yourself. And one of the questions we get asked is, where can I find a list of investors? Well, we have that list for you. All you need to do is go to growthstudio.com and scroll down to the bottom and join our newsletter. And at the bottom of the newsletter this week, you will find the list that we will be sending specifically for everyone here, plus additional materials surrounding this webinar. With me today is Gabby. Gabby is one of the directors at Growth Studio. She heads up PR, but today plays a particularly important role, and that's to make sure that I don't run over time. Those that know me will know that given the chance, I may not stop talking. So Gabby, are you happy to take that role for me?
Okay then.
Wonderful. Gabby will also be looking at your questions, as will Owen, and towards the end, we will answer your questions. So today, I wanted to answer 7 of the most common questions that we at Growth Studio get from early stage founders who are looking to raise money. And I wanted to present it to you in some form of a practical guide. By the end of this session, what I hope that you'll be able to do is understand where in the investment cycle you are. Are you seed or pre-seed? And how do you actually know? Then I'd like you to, I'm hoping you take away how to understand exactly what your fundraising options are. So there are actually many, many fundraising options, but the 2 we're going to be focusing on in particular are crowdfunding and actually approaching both retail and institutional investors. The third area I'd like to share with you how to understand whether you're ready to raise money. And most importantly is point number 4. This is a question we get so often. How do you value a business, and particularly a business that may not necessarily have actually hit the market or be driving revenue? Now, if you're able to do that, the subsequent questions are, how much money can I raise, or how much of my business do I give away? These are all one question, and you'll see why. Next, we'll move on to what investors are looking for. I'd like to help you understand exactly what to put forward to an investor to really tick all of their boxes. And then lastly, we'll talk about how to find investors, another very common question we get. And I'd like to also share with you the ideal pitch deck for how to tell a very clear story and a narrative to investors that really makes sense to them and hits all of their spots. Bit about Growth Studio. We are commercialization specialists. We are technology commercialization specialists, and we use this superpower in the space of sustainability and tech for good. We are just the people who have the tools and the know-how to grow a business in terms of both traction and raising money. The startups we work with are the experts in their particular field. We worked in, should now be 13 countries around the world. We run and participate in accelerators around the world. And as you can see from the logos, we're in good company, you're in good company, and hopefully by the end of the session, you'll see that you're also in good hands. So, as per any good presentation, as per any good pitch deck, let's start off with the problem statement. And I think as an early stage founders, this is quite close to your problem statement. You need money to take your startup to the next level. But that's really easy to say. There's a lot involved in getting your startup to that point. So what are the things that you need to do to get your startup to that point? And we're going to cover this off now. So first thing to understand is exactly where in the fundraising journey you are. Now, this session is marketed as first-time founders, so presumably most of you will be in either the idea stage, pre-seed stage, or the seed stage. But what do these stages even mean, and why do they matter? Well, let's start with the second question. The reason why these stages matter is that the money you raise sets specific expectations with investors. If you're at pre-seed stage, what you're really saying to an investor is that you don't have an MVP, a minimum viable product yet, or a demonstrator of some sort, but you are a capable founder. And look at all the research you've done. There are some strong indicators of success, but we've got nothing to show you in terms of product, nothing to show you in terms of revenue, and that's okay. If that's the sort of profile you fit, then you are a pre-seed company. Moving further down the maturity chain just a little bit to demonstrate an MVP or a demonstrator, and you can demonstrate that you have some kind of market traction in the industry, you have some kind of customers, and most importantly, you can put forward an evidenced business case, and a business case using numbers that says this is how big the market is, this is what they're currently paying, this is how much they'd be willing to pay. I spoke to this many people, and X% said that they'd purchase my product. If you get to that stage, you are most likely a seed stage company. Now, most people fall somewhere, most early stage founders fall somewhere between this spectrum and beyond seed stage, when you've hit the market, when you've found product market fit. And that's a very key term. When the market has spoken back to you and said, yes, we like your product, using various indicators, then you'll be moving on to Series A, Series B, inevitably to where I believe all of you will want to go, and that's to exit, and that's to sell your business or to IPO your business, which is the ultimate goal for most founders, not all. What do you do with the money that you get? The first thing to understand is pre-seed, by definition, you don't need as much money, you won't raise as much money as you would do with seed. The more mature your business gets, the more traction you have in your business, the less risky the investment becomes, the more investors like myself will be willing to put our hands in our pocket and give you more money because you've done the groundwork. So for pre-seed companies, you're really going to be asking investors for money to do three things, generally speaking. There may be more, maybe less. But the first thing you're going to ask investors for money for is to prove that there is a market for your product or your solution. You're also going to demonstrate that you can actually develop the solution that you're promising that you can develop. And fundamentally, and I say this because so many startups forget to do this, at pre-seed, you must begin to set up the basic infrastructure. There's no point spending this money to prove there's a market, prove you can do it, but don't set up some basic foundations within the business to allow you to raise more money and then actually take that plan to market. At seed stage, what are you asking from an investor? You're asking for money in order to validate and iterate on your MVP in order to find product market fit. You're also, the money you'll be asking for will also be used to shape the organization, start to bring on the new hires, and fundamentally the end result that both you and the investor will be looking for as a result of the money you get is to grow revenue. We're going to be focusing the rest of our presentation on these two stages. So where do you get the money from? Well, there are many different ways to get money. When we think about money, most of us think about, at least in the UK, Dragon's Den. Our American friends, I think it was Ben from Delaware, might be thinking of Shark Tank. But that's a view of how to get money. The dynamic is similar, but it's very far away from reality. Let's start with other methods first. The very first way that you could be raising money is loans and that's what we call debt funding. Now, there are some very good loans out there, some incentivized loans, but fundamentally, you need to think carefully about using debt to launch your business. You're launching a business that's not driving any revenue with liabilities. The second way you could be launching your round is through your own personal savings. And most founders have skin in the game financially in their own business, but also maybe asking friends or family. This is good, but it will only ever take you so far. Those of you in the UK and elsewhere where most governments support innovation, may be able to apply for grants. Grants are government money that's given to you in order to accelerate your business, in order to grow the economy. That's what the government want from this money. But this is really often hard to come by. And when you do find a grant that's perfectly suited to your industry, to your technology, it's very, very competitive. So let's look at the two that we often get most questions about. The two options for early stage founders are often crowdfunding and investors, institutional or retail investors. Let's talk about crowdfunding first. Crowdfunding, for those of you who may not know, is to get lots and lots of people to put in smaller tickets via some kind of online platform. Crowdcube or Seedrs are good examples of platforms here in the UK, and there'll be similar platforms elsewhere in the world. Now, crowdfunding feels like a really easy thing to do, but the absolute reality is it takes a lot of effort. It's far more effort to convince 200 people to put in 1,000 than it would be to convince one or two investors to put in much bigger sums. The second thing to really consider if you go down the crowdfunding route is there's nothing worse than an unfunded business on a crowdfunding platform. It results in a lot more questions that you have to answer to investors. Investors will wonder why your business didn't do so well, and many an assumption will be made about your business if you don't manage to crowdfund. Now, where crowdfunding is very useful is what I call to top up your fund. So you might be raising a fund of, and I'm going to make this number up, £100,000. You might get to £90,000 or £80,000 through investors, and crowdfunding then becomes a great way to just top up your existing commitments to get the last £10,000 or to top up your funds. I believe that most of you are really here to learn a little bit more about angels and VCs. Angels are people who have interests and money, and they invest in your business because they're passionate, whilst VCs are more institutional investors. They're really out there to accelerate growth of a business that they invest in and get a return from it very, very quickly. And they're quite different profiles. Most of you as early stage founders will probably more in looking for more angels or a new breed of VCs, which you'll see a lot more about are seed VCs or even pre-seed VCs. So VCs have recognized the value that everyone here on this call have and the capabilities of everyone here on this call and beyond. And they understand it's better for them to get skin in the game as early as possible. And so more and more VCs are actually investing in startups at the stage that you're at the moment. So the first question to ask yourself is, are you even ready for investment? This is the most common challenge that we see. Startups want investment, they need investment, and the business need investment, but they don't have a clear business case or even a plan for how they're going to use the money or grow their business beyond where they are right now. It's really fundamental to ask yourself, do you have a clear business case for you to be able to confidently and go up to an investor and ask for money with the confidence that this money is going to be put to good use? You know how you're going to use the money, and you'll be able to drive a return. You're not guaranteeing anything, but you need to be sure that you've got a very, very clear plan. The second thing to consider to see if you're ready or not for investment are, do you have the right skills yourself as founders, but also within your team to be able to manage not just the workload involved in raising investment. It's a lot of time. You're looking at taking a solid minimum six months out of your life to fundraise, probably more in this current economic climate. But it takes a lot of time, a lot of energy, a lot of commitment, and a lot of skill. So do you have those skills within your team to do the fundraise? And do you have those skills within your team for when you get the money to roll out the action plan, the business plan that you said that you proposed to the investor? Do you have the support? Now, this means, do you have the support not only around your business, but you as a founder? And you as a founder, the difference between you as a founder before and after you get the money is nothing at all, except now you have a few more numbers in your bank account. It can potentially be life-changing. or business training at the very, very minimum? Do you have the support? Do you know what you're doing? Do you have leadership support? If not, this is where a board of advisors could come in very handy. But also, do you have the support of your friends and your family? Most founders will recognize that the stress that they take, or the stress that they have to run a business, is often shared by their families, and we applaud our families and we thank our families, myself included, for that. But do you have the support of your family? Are you able to strike the right balance? Are you able to ensure that your partners, your parents, your children are all able to support this venture that you're doing? Because there'll be a lot of late nights, and there'll be a lot of early mornings, and there'll be a lot of very little sleep over the next 6 months. Evidence. Are you able to put forward very clear evidence as to why I, as an investor, or investors generally, should be willing to give you money for your business? Evidence comes from research. And what you really need to do is understand what's happened out there that's similar to what you're launching, but also speak to the right people and get primary evidence, primary proof points that says, if I was to launch my business, these 10 senior stakeholders, budget holders, have said that they are willing to buy my product. If it's a consumer product, you want to think far more than 10. B2B, you're looking between 10 to 20, depending on the industry. And lastly, you really want to ask yourself, are you committed enough to really, really do this? It's a very, very high pressured 6 months you're going to have fundraising. It's one that's going to mean that you'll be out and about all the time. You'll be needing to speak to a lot of people, and sometimes even very tricky personalities. Those of you who've spoken to investors before will know exactly what I mean by this. So are you ready for this? Do you have the commitment for this? So assuming you are, the next question is, how much do you give away? Another way of asking this question is, how much should I raise? Two very common questions, but they're both two sides of the same coin. So let's see how to answer that. And before we can even answer either one of those, the first thing we need to do is actually value the startup. Those of you who are numerical minded like myself will find this a little bit counterintuitive, but the reality is, whatever you raise, whether you're raising £100,000 or whether you're raising £500,000, you can expect to give away around 15% equity. It could be 10, could be 20. Now, if you're able to demonstrate that the market's in your favor, if you're able to demonstrate that there are other startups that have done particularly well in this space, or if you're able to demonstrate that you're the right person, if you have the right proof points that minimize risk, you can get your £100,000 and give away closer to the 10%. If, however, you put forward, let's call it a half-baked business case, let's call it a riskier investment that hasn't necessarily been backed up by evidence. If your business case and your pitch deck is full of assumptions, chances are that the investment you'll be getting will be at a lower valuation, and therefore you'll be giving away around 20%. But the key thing to remember is most investors at an early stage business are unlikely to get out of bed for less than around the 15% mark. Your job is to put forward a really calculated plan to push that and use your powers of persuasion, your personality. This is very important. If you're able to convince someone that your business is investable, you can push them down towards a 10% mark. But I'd like you to remember that 15% number, and let's see how to understand how much to raise versus how much to give away. You have two options here. The first way to think about how much to give away versus how much to raise is ask yourself, how much of the start of your startup do you actually want to give away? If you find after speaking to investors that £100,000 investment garners you 10%, then maybe you'll be willing to give away 20% and get 200,000. Be very careful here. You don't want to give away too much. But this is one way of you saying, well, I am going to set myself a benchmark. I don't want to give away more than 20% of my business. And that, by the way, guys, is a good rule of thumb. If an investor is asking for 30%, I would seriously question that. You don't want to give away too much too soon. But that's the first way. You don't want to give away more than 20%. You know that £100,000 gives you 10%, so maybe you want to give away 15%. Maybe you want to give away 20%, but that's the first way. Some others will be slightly different minded and would want to think about how much money do you actually want to raise for this round. And the way to calculate this is if you know that your burn rate, your monthly spend for the next 18 months, and that's really the minimum period time window that you should be thinking about, comes to around 250,000, well, maybe that equates to 30% of your business. That's far too much to give away at an early stage. So now you immediately need to immediately know that you either drop your window and raise less money, or you immediately know that you need to lower your ambitions, or most likely, chances are you're raising money too early. So you can make the right decisions. But it's really up to you how you want to see this. But remember, the amount of equity giveaway versus the amount of money you raise and the valuation of your business all sit in one not very neat set of questions, but they all basically are the same question. So how do you actually find the right investors in order to even have these conversations? To value your business, you need to speak to investors. To understand what they're willing to pay, you've got to speak to investors. How do you actually find them? That's probably one of the more common questions that we get. Well, before we do that, let's see what investors will be looking for from you. When they meet you, when you give them your pitch deck, they're really going to be looking to see, is this something that interests them? Is this something that actually they can get behind, particularly at an early stage? Earlier stage businesses need a lot more support. And that's why the investors who invest in early stage businesses like to have a bit more involvement. That's a good thing, generally. So do they share the same passion as you? The second thing they'll be looking for, second and third thing, do you have a viable plan to take your idea to market or whatever stage of business you're at? And are you taking it to a market where there is a clear opportunity? There are many, many problems that your market may have, but they may not be willing to pay for a solution. And that's the difference between having a market and market opportunity. The next thing they'll be looking for in conversations with you and your pitch deck is, do you have an absolute killer team who can really deliver? The fundamental components of your team really need to be a commercial person. That's probably your CEO. And this commercial person needs to be financially driven. They will also be looking for someone who can manage the technology, the tech person, the CTO, someone who understands the nitty-gritty of the IP. And the third thing, that minimum requirement they'll be looking for, is someone with marketing abilities who can take this to market. At the very, very fundamental baseline, they're the three skill sets you must demonstrate in your business. Not necessarily 3 different people. They could be 2 people or spread across 4 people, but they're the skills you must show. Investors will also be looking for the unique insight or the unique, what I'm calling the X factor in this case, something special about your business that's different and differentiated, and some kind of traction. What does traction mean? If you have a product that you're taking to market, that's ready to take to market, traction is going to mean leads, pre-sales, sales. Is going to mean commitments to purchase. If you don't yet have a product, or maybe your startup is at an earlier stage, traction is going to mean how many people you spoke to, how much positive feedback you got. It's going to involve how many possibly even pre-commitments or a pre-sale list do you have. But traction is really around real market-driven numbers that show the investor that the market does want this. Doesn't matter what stage you're at. And the last thing is thesis fit. Every investor has a thesis. Growth Studio, for example, we invest in sustainability and tech for good. That is our thesis. We'll work with startups in many other areas, but we'll only ever invest our time, money, and resource in those that are having a positive impact on the world. And that's why it's really, really important to do your research on the investors to ensure that the way you articulate your business, the way you put forward the opportunity really fits the language they speak and really resonates with them. But what are you looking for? And this is the bit that startup founders often forget. It's a business transaction here. When you meet with an investor, you want to understand what they're looking for, but you also need things from them as well. Think about what level of involvement you want from your investor. Do you want them to be really hands-on, or do you want them to be more passive? This is conversations you should be having with your investor. Some of you are going to feel very confident. Whether you should or not feel confident is a separate question, but you will be feeling very confident that you can do this business by yourself with the advisors that you have. You don't need an investor's involvement. Others, and I suggest most of you should be in this box, are going to value an active investor who really knows the space, has the connections, and can add value to your business as an advisor. Do they have the right expertise, the network, and the connections? So most investors will come with a network of people who may be able to help and add value in your business. The expertise will help you understand or help you validate some assumptions that you might be making in your business, or they can call you out on it. And lastly, are you willing to give them a seat on the board? At an early stage, investors are going to want not just a voice, but a formalized voice on in your business. And if that's the case, that's a great card for you to play with. What are they willing to trade in order to get this seat on the board? Are they willing to give more money, or potentially take less equity? So it is a business decision. It's a business partnership. It's not just about what the investor is looking for. You matter here as well. So where do you actually look for investors? Personal connections should always be your primary way of finding connections. It surprises me to this day how many people simply don't ask. I meet startups all the time, as does Gabby. And very, very few actually ask me, Ryan, this is my business. Do you have an investor who you think might be interested in seeing my pitch deck? Ask people, ask your friends, your family, your professional network. You'd be surprised how many people in your network are going to know the right people who will know the right people. You're going to get rejected so many times, but for every 17 to 18 no's, you'll get a yes. The way I see the world is you have 17 or 18 opportunities from every one of those no's to ask for more referrals. If I say no to investing in your business, it's not because I don't like you or like your business. It's just not for me. It could be for my industry colleagues. It could be for other investors that I know. I've given you a list of online platforms here. The key thing about these platforms is look for investors and what they've previously invested in. If you find they've invested in similar technology, similar businesses, similar geographies, they may be worth approaching. Don't forget to do your research, though. The other way to do it is to look up startups with similar technology in similar industries, with similar markets, and look on Crunchbase to see exactly who has invested in them and also approach them. Social media, I can safely say that the last 3 of my startups were invested in because of investors that we met on social media, but don't forget LinkedIn and news articles. Subscribe to Google News articles or the news bulletins that they send you every morning. I can't remember what they're called, news alerts. That's what they call news alerts. And use the right keywords to see who's investing in what in your industry. And what you'll find is you'll very quickly be able to understand the right kind of investors for you. Those news articles are also incredibly useful to be able to approach investors as a warm intro. That's a good lead-in to reach out to investors. Events. Don't avoid paid events. So many startups will only ever go to the free events, but guess what, guys? Everyone's going to free events. Paid events give huge amount of value because there's less people there and therefore less competition to speak to the right people. When I go to events, the first thing that I do is I look to see who is speaking. And if the event is scheduled to start at, I don't know, 5 in the evening, I'll get there for 4 in the evening. And the reason why I'll get there for 4 in the evening is the speakers are always invited early and they're sitting down doing absolutely nothing. No one's going to kick me out, but I get an entire hour just to myself without the competition to speak to the speakers. So no matter what event you're going to, paid or free, if the speakers are worth speaking to, make sure you go there early. Don't forget socials. Social events and networking events are hugely, hugely critical as well, because that's where you get to meet investors as people, and investors get to meet you as people. Remember, people buy from people, and relationships is hugely, hugely important here. And then, of course, you've got businesses like Growth Studio, accelerators, competitions, pitch events. What you really should really be doing is consistently be looking at all of these 5 areas to work out your next 6 months and building on this. As I say, it's going to be a hugely, hugely busy 6 months because off the back of all of this, you're going to have meetings and you're going to have rejections, and the rejections should result in more recommendations. So don't forget to prepare your digital presence. I meet so many startups and they tell me such an amazing story, and they say, I like their business, but actually there's nothing about them online. Their website's in tatters. They've got no LinkedIn following, maybe a hello world post on Twitter. If you're going to present yourself as a business worth investing in, make sure you have a good digital presence. But the reality is that the very first thing you're going to do is, after meeting an investor, is give them a pitch deck. And this can be, this is your door opener. A good pitch deck will get you a date with an investor. It's very much like, this is your Tinder profile. If I like your Tinder profile, I'll swipe right. And really what you want is to get as many investors swiping right as possible. It doesn't mean we're going to date. It just means I'm interested in dating. And similarly, investors, when they see your pitch deck, all you want to do is get that very first meeting. It doesn't mean they'll invest, but that meeting is what's crucial. Every rejection you get feedback to continuously keep improving this deck. But what I want to do is just share with you, as early stage founders, the 10 things that are fundamental to include in your pitch deck. So, firstly, after your title slide, you must include the problem and the solution in really clear English. That's the key thing. Nobody likes technical jargon or complexity. Remember, I want to share with you how investors look at pitch decks, and please keep this in mind. They will continuously keep clicking next on every slide because they've got so many pitch decks to look through. Your job is to make sure you articulate the problem, the solution, and beyond in the most simple possible way using very clear English. I normally ask my startups to think about my grandmother, 99 years old. She'll be 100 in January. Would she be able to understand the language that you're using in terms of articulating a problem and articulating a solution? If so, you're on to a winner. Traction and evidence is hugely important at this stage because right now it's just your word in the form of a pitch deck. Traction and evidence shows that you've done your research, and actually the market is backing you in creating this, in wanting a solution that you are proposing. Next is about the business, the technology. This is the IP. This is where you tell investors what's so special about your about the technology in your business and the business model around the technology, how you're going to make money. The growth strategy for those that are in the later stage of early is particularly important. And this is where you tell investors your very clear plan about how you're going to get as big as you can and how you go and what that means in terms of money. Now, we're not talking just Facebook and Twitter. Here in your growth strategy, you need to also think about internally in your business, how you're going to create the right infrastructure, but really show the investor that you understand the market dynamics, you understand the motivations in your market to create a growth strategy. Lastly, you've got your team. Show them that you're a kick-ass team. I wonder if anyone can guess what the last slide is, and I left it blank on purpose for the moment because most people actually forget this part in their pitch deck, or at least early stage founders do. It's your ask. This is how much money you need and what you're going to do with it. Remember, you want to ask that when you say what you're going to do with the money, you want to be able to deliver some very clear end outcomes. And please don't forget that whatever you write in your pitch deck is never forgotten. If you promise me you're going to develop an MVP and you're going to validate that MVP and you're going to build a team with this money, that is what my expectations are going to be at the end of the funding period. So what makes a good pitch deck? Keep it clear and human. Make sure it's branded right. And it doesn't need to contain everything. Tell me a nice story. Tell me a clear story that's not complicated with details that you can always tell me when we go on our first date later on. So this is just to keep this simple. Keep it honest and transparent. But most importantly, folks, as I flip through your slides, make sure you tell a really clear story. If I come back and say no, ask me why. Ask all of your investors why, and take that feedback. If you're seeing consistent themes for why you're getting rejections, improve your feedback. Don't fall in love with your business, fall in love with your pitch deck. Keep on improving it. And lastly, don't have a date on your pitch deck, because sometimes that can make your business or the pitch deck look old. That's just a little hint that we at Growth Studio always tell our founders. So lastly, things to be careful about when fundraising. Don't raise too much money, because my expectation as an investor will be big, and also don't raise too little, because you want to give yourself a solid minimum 18-month runway. Don't give away too much ownership. Be kind to your future self. If you give away too much now, you're diluting yourself. By your third or fourth round, there's very little motivation or incentive for you to stay in the business because you've given away too much. Make sure you have a growth strategy and don't raise too early. Make sure you're prepared, as we talked about the business plan. But what is your contingency if you don't manage to raise? What are you going to do? Investors are going to ask you this. That's a very useful thing for you to have in your back pocket. They're not going to ask you to try and trip you up, but they do want to know that you're thinking about these things. Don't ask for investment on the first date. When you first meet an investor, it's about building a relationship. They say, if you ask for advice, you'll get investment. If you ask for investment, you'll get advice. So make sure you build relationships. And also, please don't fail to research your investors. And just, I'm right on running out of time. I just want to give you some quick fire bits of advice that I give my startups when I'm getting their investment ready. Get as much advice as possible. Don't be resistant to advice. There are people out there who really know what they're talking about. And believe it or not, most people you speak to really want you to do well. Don't fear rejection, because you're going to get a lot of it. But make sure you do your research. Have a strategy for how you're going to actually fundraise, and keep on refining that. But most importantly, it surprises me how many founders who are looking for investment spend most of their time at their desk on their computer. And I'm wondering, what on earth are you doing? You should be getting out there. You should be speaking to people. If you're not having multiple meetings a day, chances are you're not working hard enough for fundraising. And I urge you to work hard on this right now, particularly in the current economic climate. Money's getting harder to come by. Mostly, this is tough, but enjoy the journey that you're all taking. It's tough, but I promise you it's hugely, hugely rewarding. So enjoy it. You are the shoulders you are the giants upon whose shoulders future entrepreneurs in your industry will stand on. To make sure you wear your founder title as a badge of honor. So guys, those were the 7 questions that we get very regularly. I hope I've summarized this. I know I've flown through this, but I wanted to kind of really answer those questions and give you some practical guides on how you can tackle those if they're the questions that you have. Owen, I think I'm happy to take questions if we have time.
Yeah. Sweet. So Dante had a question there. He said, can you elaborate further on traction means, please, particularly during pre-stage or pre-seed stage, and how to demonstrate a robust traction?
Yeah, this is good. Dante, it's a good question. So if I have a product that's selling, I have traction. That's easy, right? We can park that. If you don't have a product, or your product is pre-market, the challenge that you have is proving to an investor that actually this product will work. Now, in the absence of really solid sales numbers, what do you have left? The numbers that you can think about getting are maybe go out and ask people, would they buy a solution that does this? Or how much of a problem is this? How much would you spend on buying a solution that can solve this problem for you? But think about survey questions. Think about the numbers that you can put behind behind your solution. That when if an investor says to you, Dante, I don't believe you, right? I don't believe anyone's going to want this. What numbers can you put forward? The answer really is in research and conducting primary research. So go out there and speak to people. That's going to be your primary mechanism. The other way of thinking about it is by doing secondary research and getting industry reports if you're a B2B company or even B2C, but understand how big of a problem this is. Those are traction metrics for those of you who are at idea stage, or those of you who have a product but haven't quite taken it to market yet. What else have you got me, Owen? Bring it on.
Nice. Yeah, no, couldn't agree with you more on that one. The other question that came in was, this is from Nadia, which was, what if your family don't provide support? Does that mean you stop your growth?
No, look, so this is a very, very personal thing. Okay. So if your family aren't providing you with support, the questions that I would advise my founders to think about is, okay, well, how are you going to look after your responsibilities outside of work whilst also being able to manage what's happening in work? And those are the questions to really try and answer. Now, if you think about it, Nadia, every single person in this Zoom room, every single person in any cohort of startups has a different level of support from their families and has different capabilities, different abilities and of how much they're able to push themselves. Everyone's got a different approach, everyone's in a different situation. The reason why this is important is, what is your strategy to deal with this? What are you going to do to kind of manage a lack of support from those around you? It doesn't mean quit your business. It means, how are you going to work around it? That's the key thing. Now, the reality is family always comes first. Family should always come first. I think very few would disagree with that. So there are situations where you may think, okay, you know what? I may put my business on hold until I can establish some understanding with my family and then pick it up again. That is not a failure, should that happen.
Yeah, couldn't agree. And I think the other thing that I kind of mentioned in the chat as well, just as an FYI, is like, you can also use your family or you can also use your friends and people that are in your network, essentially, that you are quite close to for the same purposes. So again, your family might be a little bit more risk averse, but that doesn't mean that you don't surround yourself with other founders or other people in your network or friends that are essentially going for similar goals, but will give you kind of constructive feedback. And I think that's also one of the key things I would say, is also don't surround yourselves too much with yes people. Sometimes it's always key to get people that will be happily to critique your content, whether you like that person or not. Getting negative feedback sometimes is the best thing that you can do, because you can make those little tweaks and changes that will make you even more applicable to the right types of investors.
You're absolutely right. I mean, and just to add two things, when family support isn't ideal, there's a number of things, possibilities to think about. And friends, the first is, are you being fair to them? So let's be introspective first. Are you asking too much from them? That is a huge possibility. It's a tough thing that you're all doing it. The second is, are they right? So if is negativity from your friends and family actually, do they have a point? And maybe we as founders are so glued to our idea that we're struggling to see the wood from the tree. They may have a point. And the third thing is, I know that families and friends generally are supportive, but they also care, and they care about what happens if you fail, and they care about what happens if you don't achieve these ambitions. So oftentimes, what looks like a lack of support is actually out of fear and protection. So there's many things going on, but just to echo Owen's original point, look, like Gabby will testify, I am one of these founders that I love good feedback, and hopefully I'll get good feedback from this, but I prefer criticism. I prefer ways to improve, right? So that's really what you should be doing here, right? So like, everyone's got something interesting to add to your business if you ask the right questions.
And there's quite a few questions on the open Q&A there, I'm seeing. There's one from Finn saying, what kind of environmental and social value sectors are investors looking at most right now?
Oh, such a good question. So this really does depend on where you are. The biggest challenge that the world is facing right now is the increasingly rapid change of that atmospheric conditions, the warming of the earth. It's damaging supply chains. It's melting bridges and it's melting big infrastructure. It's making it's making raw materials so much harder to get hold of. It's making land less fertile. Climate change, which is big, but the effects of climate change is such a big area right now. The second area that's really, really big is a circular economy. We as particularly the Western world, have just woken up to this concept of one man's trash is another man's treasure. And there's so much value in this. So circular economy, how you can take waste products from one sector, one industry, do something clever with it, and create something new is massive. In London, we know the air pollution is a massive problem. It's a big problem in Mumbai, and I can't remember who it was. I think Dante was from Abu Dhabi. Big focus in the Emirates as well. The way to think about it is this: what is it that's going what is going to be damaging people's health? What is going to be damaging the environment? And what are the effects of climate change? If you kind of ask yourself those sorts of questions, you'll be in the right sort of space. And waste minimization. How, in any industry, how can we minimize waste? But that's a really good question. Thank you for that.
I'd also add to that as well is I myself own a circular based business. I own actually 3 of them. And one of the big parts of that when you're looking for to get investor ready is to make sure that, and like what Ryan mentioned the whole way through, is to actually make sure your business model makes sense. So like, yes, you can be, an eco warrior, but does the business actually make money? And is there a profit and is there traction? So having that, you kind of have to play devil's advocate a little bit because you kind of have to play both sides. You have to play the economy side, the climate side, but you also have to remember we're still a business, so we still have to make money, but we can do it in the right way. So there's a couple of really good books on it. If anyone's read, there's a book around Plan A, and there's also the B Corp book. It's worth reading if you're kind of interested in that space as well.
Yeah, I agree. Fully agree. And I think one more thing to add there is, don't be ashamed to make money by doing good. That is the future.
Yeah.
Right?
Great.
That is the future. So investors want to hear that you're doing good and you're going to make money for it.
Because if you ever actually look, there's a very good case study on Adidas about this. And they were using recycled materials to 3D print shoes.
Mm-hmm.
And it was until Adidas started doing that it became a scalable business model. So then there's others that have followed through. So sometimes it takes oh my God, this can actually make us money to get people to actually build businesses based on it as well, which is super interesting. I'm going to jump in. Sorry, Ryan, just from Ben had a question here. It said, at early seed or late pre-seed stage, how are small business grants awards perceived by potential investors? Can it tame investors' appetite? And if so, how can we mitigate that?
Okay, good. Gabby, do you want to take that question around the impact of awards on an early stage business? And is that seen positively?
I don't think that's my area of expertise, Ryan. I'm so sorry. I would.
No. So I'll take that. So I only asked Gabby because Gabby's kind of looking at the same kind of question for us at the moment. It's around, should we be kind of entering awards? What impact do awards have for us? Here's the thing. It depends on the award, who's giving the award, and how you got nominated. I think
Ryan, I think the question was about grants rather.
It's more about grant. It's more of a grant reward. So getting a grant.
Oh, sorry, Owen. It was the accent thing that lost me. That lost me.
The beautiful Irish accent of mine.
Okay, hit me with the question one more time, but this time I'll be thinking grants.
So at an early stage or pre-seed stage, how can a small business grant award be perceived essentially by investors?
Absolutely fine. Good. Why not? Look, it's free money. Look, if there's a grant available and a startup comes to me and asks for money, and I know that grant's available, I'd be questioning why that founder didn't get free money from the government. If a founder comes to me and says, like, I've taken a grant from the government, or the grant, I've been awarded a grant from the government, it says to me that this person has applied for a grant with many other people and has won it. They're doing something interesting. That's the first thing that I'll be thinking, right? Because you've come with a grant. The second thing I'll be thinking is, okay, I'm not investing in a really early stage business. They've taken some money and they've done something. They're only coming to me because they've used grant money to get themselves to a certain level of confidence. If grant money is available, folks, take the money. Like, the startups we work with who are much later stage will take the grant, will take grants. Grants are there to help you because you help the rest of us in the economy. Take the money.
Cool. Another question that came in here, which was about how difficult do you think it is for African or Nigerian founders to raise, especially with respect to low investor confidence, with recent use of funds by founders?
Okay, now this is a very good question. We've done a lot of work in South Africa, and we've actually have founders from Nigeria. Now, it's very true that the relationship and the ecosystem here in the UK is a lot more open. In America, there's even more trust. So here, I might be battling to get £100,000 there. In America, you can arguably get double, treble that quite easily. And it's down to the number of investors and investor trust and what you need to show investors. It is a lot trickier in certain markets to raise. And I think, I'm not sure how I can really answer beyond that. It's very situation dependent. But the challenge that you have is everything I showed you around what you need to show in your pitch deck, what you need to be articulating to investors. I want you to multiply that by 5, 10, whatever you need to multiply by. You need to do a lot more work. Unfortunately, that's just the reality of the situation you're in. So I may get away with 3 or 4 solid traction points. You might need 5 or 6. I may get away by showing research and how many people would be interested in my product. You may need to show actual pre-sales. So think about everything I've said, but just go that little bit more hard line, and that's your route out. And this is what we say to. And Dante, you're in the same position in the UAE. UAE is slightly more open, but again, the investor, particularly angel ecosystem, is only just opening up. Right, trust is low. They need a lot more confidence. Show as much confidence as you can. Those of you in the UK or in Europe, we're in the sweet spot. Americans generally getting money is a lot easier compared to the questioner who's in Nigeria.
Yeah, couldn't agree more. I'm gonna take 2 more of these questions, and then for anyone else, you can follow up. I've left a link to Grow Studio and to HubSpot, so if you have any questions, we can tackle it. Are you guys okay for one more question?
Absolutely.
Yeah.
Bring it on. Make it a hard one. Go on.
Right, cool. So there's a couple of other ones. So first off, for everyone that's still on the call, I will be sending the slides as well as the recording today. So we will have them. Anyone's questions that we haven't got to, we will answer them through that email as well. So just as an FYI. So I'm actually going to I'm going to combine 2 questions in one.
Yeah.
So when you talk to investors initially during that first conversation, do you pitch our solution to about how that can help their portfolio? And if so, how would that look for investors?
So is a question, do you pitch your solution as to how it can help their portfolio rather than help the market?
Yeah.
Yeah, look, so investors first and foremost are looking to see how you are going to help solve a market need that is going to drive a financial return. That's the first thing. That's what you need to That's the first hurdle you have to jump through. If then you happen to also be complementary to other businesses in that portfolio, then great. But an investor will be unlikely to be interested in your business if all you can do is help their portfolio without making money. So an investor is looking at how you're going to make money and how you're inevitably going to exit. And that doesn't mean that you need to help their portfolio companies. To flip that, an investor will be much more likely to invest in your business if it's going to make real money and exit for lots and lots of cash, but doesn't necessarily help any of the other companies in the portfolio. What an investor is going to look for, they're going to have an eye on, like a side eye, right? They're going to be looking at, does your business align? Is it similar to the rest of the portfolio? But are they going to be looking for whether it helps their portfolio company specifically? No.
I'd even add to that, Ryan, and I use a quote in every workshop I've ever ran, which is nobody cares about your product and service. They only care about the solution that you solve.
Yeah.
And why I always say that is the only person that really cares is you about your own product. So I would argue, don't pitch your own product on how it's going to help their portfolio. You just show them how to make them money, because an investor cares about two things. They care about how to make money or how to save money. And that's it. And sometimes we get overcomplicated or we get overly complex about our own. And I describe it as eating your own dog food. You essentially get too excited and too into your own product, then you actually forget about the cornerstones of what we're trying to do, which is essentially solve a pain or a need that a customer has. And I think what Ryan has done today is given us a very clear overview on how you can structure that in the right way. But I think you always have to remember, it's all about them. It's not about you, it's about them. How can you put yourself forward to show them that you are going to be successful so that they can line their pockets?
Yeah.
And sometimes it's as simple as that.
Can I add on to that really quickly? Here's a little acid test for everyone, right? To see, to Owen's point, are you putting your customer at the center of your business? If you're pitching or you're talking about your business and you keep saying we, our, me, us, you are not putting your customer at the center of your business. But you can say the exact same thing, but flip it, reposition that same sentence that was about we, us, our technology. Now just reposition to be about the customer, and then you'll do a lot better. And I think, just add on, when you talk about no one cares about your product, my God, this is so true. Think about it like this: nobody wants a drill, everyone wants a hole in the wall, right? Another way of putting that, something that I say in every workshop I do is, founders are like they're inside the bottle trying to read the label on the outside. That's what everyone else is. So you're all inside your own bottle trying to read what should be on the label. Come out of the bottle. What is it that you want people to know about what you can do for them? What's in the bottle? They don't care. None of you here know what's in your can of Coke. You don't know what the ingredients are.
And the reason why me and Ryan are being so, I suppose, pushy at this at the end is that I've done it. I've been in that bottle.
Yeah.
Like, I've been the person that's talked about banging the drum about how great my product and service is without actually flipping it on the head of the customer. And then when I flipped it on the head of the customer, I seen growth trajectory of my business grow 10x because I actually flipped my mindset to focus customer centric first, and then also thinking about my investors. Like, at the end of the day, they need an outcome from me. How do I get an outcome? I actually need to think about my customers better.
Absolutely. And if this is a concept that you want to research more about, please look up customer-centric design. Please look up value proposition design. Value proposition design is all about how you articulate value to a customer in a clear, concise, and comprehensive way that really resonates with the need that they have. Value proposition design is what we're talking about.
Cool. Well, look, we've gone massively over. I'm sure we'll be back again in the future. We'll be definitely letting you all know. We will follow back up with the slides, With any other questions that we haven't got to, we'll put that in, and we'll also send you guys across the video from today. Thank you so much for everyone that stayed until the very end. I know Q&A and we've gone slightly over, so I appreciate you all staying. Again, different time zones, so I appreciate everyone, whether it's morning or late evening. We really appreciate it. And yeah, thank you all so much for joining, and we hope to see you again soon.
Thank you so much. Take care, everyone.